Hi everyone, and welcome to this second episode of Beyond the Markets, where every week we will break down the biggest financial and geopolitical news, analyze the key indices, and look ahead at what's coming next. Today we will start with Trump's tariff pause. We're breaking down President Trump's latest decision to temporarily reverse tariffs on imports from Canada and Mexico. So here's the deal. Just days ago, the US imposed sweeping 25% tariffs on Canadian and Mexican imports. But now, Trump says some goods from these countries, specifically those compliant with the USMCA trade agreement, will be temporarily excluded from these tariffs. That covers about 38% of Canadian imports and 50% of Mexican ones. Trump claims this move is to help Canada and Mexico, as well as American car makers. But this pause will only last until early next month. So why is Trump doing this? The official reason? Trump says that these tariffs are a form of punishment because Canada and Mexico haven't done enough to stop illegal immigration and drug trafficking into the US. But there's more to it than that. Tariffs are also part of his broader strategy to bring manufacturing jobs back to the US by making foreign imports more expensive. But here's the problem. Economists warn that tariffs can backfire in several ways. For example, higher prices for American consumers, slower economic growth, lower profits for businesses, job losses in industries that are reliant on trade, and of course, also increased tensions with trading partners. David Kelly from JP Morgan put it best when he said, "The trouble with tariffs is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine." This clearly shows that Mr. Kelly doesn't really like the tariffs that Trump imposed. So, what happens after April 2nd? If Trump reinstates these tariffs, businesses that rely on Canadian and Mexican imports, especially car manufacturers, could face higher costs, which may lead to job cuts and price hikes. But this could also be a strategic move. With elections coming up, Trump might be using tariffs as leverage to pressure Canada and Mexico while appealing to American manufacturing workers. Our second topic for today is Europe's €800 billion spending plan. On the 6th of March, European Commission President Ursula von der Leyen unveiled a game-changing plan with the goal to rearm Europe. This allows European countries to boost defense spending, even if it means breaking the EU's 3% budget deficit rule. The goal of this plan? To strengthen European security while reducing reliance on the US. Europe could raise nearly €650 billion over 4 years, plus an additional €150 billion loan for defense investment. That's a total of €8 billion, fueling the European arms industry like never before. This is really unseen. Since the war in Ukraine began, the US has provided about €64 billion in military aid, while the EU, UK and Norway combined have sent around €61.9 billion. But now, the US is stepping back, especially with Trump back in office. After a tense meeting with Ukraine's President Zelensky on the 28th of February, Trump signaled he may suspend military aid for Ukraine. The impact? Europe is now stepping up to fill the gap. This €8 billion investment is a game changer for European defense companies. Just a few days before the announcement, UK Prime Minister Keir Starmer signed a €1.9 billion deal to supply 5,000 lightweight multi-role missiles designed to take down drones and helicopters. European and UK companies like Thales, Saab and Rheinmetall are set to profit massively from this. Thales, for example, has already seen a 50% stock price increase since the start of the war in Ukraine. With the US pulling back, Europe's coalition of the willing, including most of the EU, UK and Norway, will now take the lead, flying Ukraine with weapons. But defense isn't just about weapons, it's about technology. Ukraine's military has relied heavily on Elon Musk's Starlink satellites for battlefield communication. But now, SpaceX may cut Ukraine's access unless Kiev agrees to give the US access to rare earth metals and lithium. Europe isn't waiting around. French satellite company Eutelsat is in talks to replace Starlink. After rumors of a Starlink withdrawal, Eutelsat's stock price tripled in just 2 days, and it's still going, now almost increasing 6x. So who are the big winners? The biggest winners are of course European defense companies. For example, Germany's Rheinmetall, which produces heavy tanks and heavy military equipment. Thales, located in France, which supplies missiles, satellites and high-tech systems. Sweden's Saab, leading in aerospace and missile technology. In addition, we have the UK's BAE Systems, which is well positioned to benefit from increased military budgets. Europe is clearly entering a new era of defense autonomy. The Rearm Europe plan marks a massive shift away from US dependence and a move towards a self-sufficient European defense industry. This caused a massive boom in European defense companies' stock prices, but with the big caveat that most of these defense companies don't have the production facilities to fulfill these orders. It remains to be seen that a lot of these companies can remain to trade at such hefty valuations. A lot of volatility is likely ahead. For our last topic, we have Trump's new tariff threats and what it means for Canada and the US economy. Donald Trump is making headlines again with his latest tariff threats on Canada, including a massive 250% tax on dairy imports. This comes just one day after he announced a temporary pause on tariffs under the USMCA agreement. So what does this mean for trade and the economy? Let's break it down. Trump mentioned Canada has been ripping them off for years on lumber and dairy. It's not fair, never has been fair. We're going to charge the same thing, is what Trump said. Trump is clearly upset about Canada's dairy tariff. It can go up to 250% on certain US dairy products. In response, he's proposing matching tariffs on Canadian dairy and lumber. Canada has a quota system in place to protect its dairy farmers. 241% tariff only applies if US dairy imports exceed that quota, which rarely happens. So while the number sounds extreme, its actually economic impact is limited. Another major concern is lumber. The US already imposes a 14.5% duty on Canadian lumber, but Trump now wants to go even further. The markets had a strong negative reaction on these Trump's tariff threats, but recovered after Fed Chair Jerome Powell reassured investors that the economy was still going strong. So, will these tariffs go into effect? Trump says it could happen as early as Monday. Now, let us take a look at our charts. Last week, we discussed selling the 7 days to expiration short straddle, which would have generated a loss of $644 this week. This shows how volatile the market has been this week, unfortunately, mostly to the downside. The volatility was priced incorrectly this week by the market makers. This was also reflected in the $900 million loss one of the top hedge funds, Millennium, suffered this week. We also went straight through both of the pins that were visible on the options chain. So we can conclude, while market makers are normally excellent at pricing the risk, this week selling the pins would have caused significant losses. Moving on to the S&P, which we monitor by the SPY ETF, we can see that the S&P 500 ETF SPY had another volatile week. The SPY closed the week down 3.07%, closing at $572.92 per share and reaching a high of $597.34 per share, or $565.63 per share respectively. The SPY to a very strong support level, reaching the low of early January. Now let's move forward to the open interest. When we take a look at the open interest, we see significant open interest on the put side. The 430, 440, 480, 490, 530 and 540 strikes have a large amount of open interest. Above 560, we see more clustering across the strikes, which is more reasonable as these are closer to the current price of the SPY. While it didn't look good, the SPY was able to close above its 200-day exponential moving average, which might act as support next week. When we look at the call side, the 600 call is the most notable, but even this one only has 1/7 of the open interest compared to the 480 and 490 puts. It is clear that some people or institutions are aggressively betting on a collapse next week, but these puts are most likely hedged by other instruments, like futures or other ETFs. Market makers will have the possibility to make a lot of money on SPY this week if they are able to let these puts expire worthless, which should be doable. The straddle this week is priced at $14.89, which is significantly higher than last week when it was priced at $11.65. Selling the straddle could potentially be very profitable this week as significant volatility is priced in. This gives us an interval between $561.03 and $590.91 for the straddle to be profitable. Max pain currently sits at around $586 for the expiration next Friday. The Nasdaq closed the week down 3.27%, reaching 20.2k. The NDX reached a high of 21.073k and a low of 19.736k this week. We even briefly dropped below the 50-week exponential moving average. The last time the Nasdaq was below the 50-week exponential moving average was over 2 years ago. The Russell 2000 closed the week down 4.06%, reaching 2.077k. The Russell is still in shambles, down over 16% from its all-time high. The Russell is now fairly close to trading at its 200-week exponential moving average. The Russell reached a high of 2.195k and a low of 2.034k respectively this week. That was it for this week's Beyond the Markets. Feel free to like, subscribe and put on the notification bell so you don't miss out on future videos. Let us know what content we should cover next. Thanks for watching and see you next time.